Hi, good morning this morning. I am Malan KB and this is the third video in this course Forex Starter Kit. And today we are going to discuss some basic concept of Forex trading. Like you know, it's for beginners, so we are starting from the scratch. Some people might not teach you all this, but I feel it's necessary for you to know all this. So the first thing you need to understand is PIP. So what is PIP? In any profession or in anything that has to do with measurement, there is unit or there is the way they call their own way of measurement. For example, tailors measures in inch. We measure light in watts or kilowatts. We measure gold in kilogram or gram and ounce, things like that. So in forex we measure in pips. So pips is an exchange rates are measured in pips. So that's just what pips mean. I believe this is clear. Then we have pipette. The pipette is fractional pip. That's 1/10 of a pip is called a pipette. So this is just a measurement or unit that we use in forex. So to make this clear with an example, we have gold here. I told you about gold in the previous video, which is XAU USD. That's gold versus US dollar. So let's assume the price of gold is 3336.8. So this number after decimal point represents 1 pip. This number before this decimal point represents 10 pip. This one represents 100 pip. This one represents 10,000 pip, and this one represents 10,000 pip. So let's assume the price of gold was at 3336.0. So moving to 3336.8 means it has moved 8 pip. So if this number moved to 9 and 10, it becomes 0, and this 3336 changed to 3337. That means gold has moved 10 pip. If this 3336 changed to 3346, it has moved 100 pip. And if this 3336 changed to 3436, it has moved 1000 pip, and the same thing here, 10,000 pip. So that is how to know the number of pip on gold. We'll come to pip calculation in the course area, but for now I just want you to understand what pip means and what 1 pip or 10 pip means. That is for gold. It is not the same thing for other currencies. For example, here we have GBP USD. GBP USD, most likely you will see the price comes with 1.2655 or 2.2655 or something like that. The number, the first digit, the first number, then the decimal point, then other 4 numbers. So the fourth number after the decimal point is 1 pip. When this 5 is like when let's assume the price of GBP USD is 1.2650. So now it is at 1.2655. It has moved 5 pip. So imagine if it moved to 1.265, that is 10 pip. 1.275, that's 100 pip. 1.3, that's 1000 pip, and if this change, that's 10,000 pip. So that is how to calculate pip on this GBP USD. So other currencies have their own way of calculating their pips, but I am just sharing this as an information for you to understand, because we will only be focusing more on gold. So I'm not going to calculate, or when it comes to pip calculation, I'm not going to focus on this GBP USD or any other currency pair. I'll focus more on gold. So I hope this is clear about pip. So the next thing we are going to talk about is lot size, which also for this video it's going to be a highlight or a basic information about lot size. So when we start trading, or when we come to practical aspect of this course, we are going to understand more of lot size and how to use them. So we have three types of lot size, and what this lot size means is the power, or yes, the power that you use to enter market. So when you are using bigger lot size, you are entering the market with much power, and you are highly, like, you are going to make more money, unlike if you are using smaller lot size. I'll explain more when we come to lot size. So we have three types of lot size. We have the standard lot size, we have the mini, and we have the micro. The micro lot size is the smallest one, the mini is the medium, and the standard is the bigger one. So 10 lot size, like, I don't need to keep repeating myself when I'm trying to explain all this. I'm trying to explain it based on gold. That's gold basis USD, XAUSD, XAUUSD. So whenever I'm explaining all this, if I'm referring to another currency pair, I will mention it. But if I did not mention it, just know that I am talking about gold. So for standard lot size on gold is $10. That is, if market move 10 pip away from your entry, if market move 10 pip away from your entry, and you are using one standard lot size, then you are going to make $10 times 10, which is $100. So one lot size is equal to $10. Then the second one is mini lot size, which is 0.1. 0.1 is the mini lot size. 1.0 is the standard lot size. Then micro lot size is 0.01. So now what this means is, if gold move 1 pip on mini lot size, you are going to make $1 profit. And if market goes against you with $1, you are going to lose. Well, if market goes against you with 1 pip, you are going to lose $1. If market goes in your favor with 10 pips and you are using mini lot size, you are going to make $10. So that's mini lot size. If then for micro lot size, which is the smallest, if market goes against you with 1 pip, you are going to make 10 cents. You are going to make 10 cents. If market goes against you with $10, you are going to lose 10 cents. That's 0.01, which is the mini lot size. So I think this is clear. We're going to talk more on this, and I'm going to show you how to use it when we comes to the practical aspect. So the next thing you need to understand is the bid. When we say when we talk about bid, you are paying when you are selling. Like I told you earlier in the previous video, if you are selling a particular currency, if you are selling, you are also buying the quote currency as well. I've explained this in the previous video. So when you are selling, you are paying the bid price. That is, I come to an occasion. I know you all know about bidding. If government want to issue a contract or or they want to sell something, they do what we call bidding. So for those that are selling, they are paying the bid price. When you are selling, you pay the bid price, and when you are buying, you are paying the ask price. When you are selling, you pay the bid price, and when you are buying, you pay the ask price. Now, the difference between the bidding price and the asking price is called spread. Spread is the difference between bid and ask price. Now let me make this more clearer. If you go to the bank and you want to buy dollar, you will see the price of buy is different from the price if you come to sell the dollar, or if you go to bureau de change to exchange naira with dollar or any currency, the amount you are paying, that difference between buying and selling price is called the spread. Then the next thing is broker. As a retail trader, you need a broker. You yourself individually is a retail trader. No matter how much amount you are going to enter the market with, you are a retail trader. So as a retail trader, you need a broker. And you need a broker to access and trade the forex market, because broker offers you leverage and it gives you access to the international market. So now what is this leverage? Leverage is a purchasing power given to you by a broker to be able to open more positions that are greater than your margin. Your margin is the money you deposited in your trading account. So they give you this purchasing power to be able to buy more, or to be able to open more positions than your capital or than your money can actually buy for you. So all these things are going to be more clearer for you when we start trading. Now, the next thing I'm going to talk about is the trading strategies. We have millions of strategies, but for the purpose of this video, we are going to talk about only 4. Number 1 is the scalping. Scalping strategy is a trading strategy whereby you hold trades for few minutes, maybe 5 minutes, 10 minutes, or 15 minutes. In fact, some scalpers do 1 minute or 2 minutes and they are out. They'll just open position with bigger lot size. It will pay them and they'll close the positions. They'll make their profit. So that's scalping. You just enter the market and make your profit for few minutes. Then second one is day trading. And this is a strategy whereby you trade the whole day. You can hold a trade for the whole day. You enter a trade from morning and you won't go out of that trade till evening or till the next day. So that's day trading. Then swing trading is a trading strategy whereby traders hold trade for weeks or months. Yes, that's swing trading. They hold trade for weeks or even months. Then lastly, we have position traders, and this is a trading strategy whereby traders hold trade for months or even a year. And these position traders, they don't focus on technical analysis. They solely focus on fundamentals. If we say fundamental analysis, which we are going to discuss later, it's analysis that has to do with political or economic activities of a country that have impact, or that have influence in the market. So maybe they had or they know the news of gold going to 4,000 or 5,000 in the next 2 or 3 years. So they will open their position today and they will hold it till next 2 years until gold reach that amount, and they will take their profit. So that's position trading. I think we are going to stop here for this video and see you in the next video. Thank you.